Good evening, guys. So, in this episode of the Beginner Trading Mentorship, we're going to do our daily experience gainer, and then we are going to talk about error ratio, what it is, and why is it so important in trading. So let's start from the daily chart. Our daily experience gainer. This low has been broken. So now the most recent important low is this one. Yes. Then get down to the 4-hour chart. Yeah, pretty interesting price action here. Yes. So I'm gonna change the color into yellow. Okay. Then on 1-hour chart, we see the weekly low has changed and has become this one. Perfect. While the weekly high is still the same, the daily high instead is just right here. And the daily low is the same as the weekly low. So now let's talk about error ratio. I'm gonna get into this chart, which is fully white. Okay, so let's talk about it. The error ratio, the error risk to reward ratio, which we represent with RR, is the comparison between the take profit and the stop loss. So how do we understand our risk to reward ratio here on TradingView? So we can go here. You see we have these two things, long position and short position. Let's say we want to have a long. So you put your stop loss whenever where it needs to be, and then your take profit where it needs to be, and you see here risk to reward ratio, and you see in this case it's at 2.38. It means that the take profit is 2.38 times larger than the stop loss. Okay, so of course statistically the bigger the R ratio, the harder it will be to reach take profit, because it's too far away. Okay, so for example, if we have this short position here, okay, with this, and maybe the market goes like this, short about right here, okay, the market then starts alright, and so all the way down there, maybe then reverses. So that's why it is harder, because there is more space to get to our take profit. So statistically, if you just place trades randomly without even looking at the market, having a 1-to-1 risk to reward ratio, so it means that our take profit is just as wide as our stop loss. Having this, we have technically a 50% probability of winning this trade. Okay, so the higher we want our error ratio gets, the lower the probability will get to. So I always keep my error ratio as 2, so my take profit is double than my stop loss, because this allows me to take some losing trades without them affecting my account. Because, for example, if I'm risking 1,000 and in the first trade I make 2,000, okay, and then I lose 1,000, and then maybe I make another 2,000, and then I lose 1,000, and I lose 1,000 again. So if these are my trades, then even if I got more losing trades, I would still have made a profit of $1,000. You understand me? Because my air ratio was really good to my part. So yeah, all this would have made me still 1,000. So this is why error ratio is so important. I strongly suggest you to keep your error ratio above 1 to 1. Your take profit needs to be always at least large as your stop loss, never tighter. If you're just starting out, of course, if you're experienced, then you may have found a style of trading which implies your take profit to be so close. But I personally advise you to keep your take profit wider than the stop loss. So, this was all for today. I hope you liked the video and wish you a good night and a good weekend, of course.